Hello, today is Saturday, June 20th. Strong cases to be bullish and bearish on the stock market. This is your weekend report. Hello, this is Jonathan Gurney, Portfolio Manager at Gurney Financial. Friendly reminder that this post is for informational purposes only. Our goal really through these videos, through these posts, is to give you a real perspective of what we're seeing. There are bullish charts right now. There are bearish charts right now. And that's why we've been saying for, the entire last week, don't be surprised if we trade a little range bound. It is a frustrating process that leads to good things. So short term, I'm a little cautious. We're seeing case count continue to increase and some more of the first real wave states. But really, I would be paying attention more to New York. If they get a second wave, that's not going to bode well for the market. That's just the reality. Right now, price action is not bad. Let's go over the charts so we can kind of show you what we're seeing and give you a real balanced approach. So as you can see, here's the performance for the week right here. Does it surprise you to see the NASDAQ, which is mainly growth tech companies, that's a very broad summary, just so you're aware, doing better than the rest? That does not surprise me at all. That's where I want to be. The leaders, momentum, and growth. Okay? So there's the performance right there. The price action is not bad at all. Yesterday, the most recent Friday, was a bit ugly, to be honest with you, because Apple basically said, hey, in some of these areas, some of these states that are getting their really true first wave, case count is increasing, we're going to close down stores. And the market had a hard time holding key levels. And so let's look at the charts and we will go from there. I'm going to start with this one, the S&P 500, the summary. Okay, so the title of our session is very clear. There's bullish and bearish things, and that's where I'm thinking it's going to be a tug of war between a tight range here. There is a voice, there is a chart, there is an opinion for every possible scenario right now, and it can be a little overwhelming, and we want to be real about that. We see that, we feel that. With that being said, this is a friendly reminder because politics are really going to ramp up, especially with everything going on right now and an election coming up. Do not bring your politics into investing. It leads to emotional decisions where you will not do well. Period. So what usually happens during an election is you see a little bit of sideways movement to potentially even downside that ends up leading to very, very good things regardless of whether a Democrat or Republican becomes president. The honest truth. There it is. So not anything to really be hugely concerned about there, okay? If we are overbought at those levels, we probably will take some off. So want to be real about that. So here's the course of action, okay? Early February, huge plunge. We are fortunate to have about 50% in cash near the peak. We got out at 33.80. Yes, 33.80. So we were watching key levels and got out at key levels, okay? Wish we would have sold more, but not complaining. We bought really close to the bottom, got out a little bit early, to be honest with you. We had about 40% invested at this level, sold a couple days before this took a big plunge. Again, the reason we sold, PutCall Ratio is very low, which shows complacency, meaning people are just buying, fear of missing out. They think this is going to just continue to go higher after a 44% gain. It's an emotional market right now. Once selling starts, people sell. Once people buy, people feel like they're missing out on the rally. So some little give here would not surprise me. So 2 weeks ago, we saw a test of the 200-day moving average. Again, the S&P 500 is a macro overarching summary. This is not what we are invested in. It is a summary. It is something that we pay attention to. Top-down approach to say, hey, if the market is doing X, most will follow suit, not all. The leaders are actually doing much better than the S&P 500, which is usually where we are at momentum leaders, growth names. That's where we want to be. So we tested as high as 32, 33, went directly to the 200-day moving average, basically a 5 to 7% dip depending on the index in one day. That's a big dip. So we were at 5% invested at the peak and bought about 20% more. So we're about 20 to 25% invested at this point. There was a wall at the 3100 and I was seeing indicators. The put call ratio is some of the lowest in the 19th lowest put call ratio in basically history. And that shows some complacency. So I took some more off, followed my course of action, watched price action, like, a little pullback probably will happen here. So I'm a realist in saying short term, there are some concerns. Midterm and long term, though, I'm going to be honest with you. You need to understand that the market will probably go higher here. Mid and long term. Again, there are going to June through probably the election is going to likely to be sideways. I don't expect a ton of upside, but by year end, I do expect us to be higher than we are now. So in short, this will lead to good things. It's going to be frustrating, but it will lead to good things. Short term, there are concerns, legitimate concerns. So there's the bullish side, there's the bearish side, okay? So we're going to take you to some more bullish and bearish indicators, okay? We just talked about the put call ratio. This is what we wanted to show you. Put call ratio is the 19th most overbought day in 20 years. Okay, that's pretty significant. I pay attention to those things. I'm well aware of those things, and that's why I reduce risk during those times. Okay, so we're saying, okay, put call ratio. If you don't know what that is, it's basically people getting into the market without any real protection. They're just buying like crazy and there's no real insurance to the downside in case things go down, which usually leads to, not necessarily right away, but usually leads to within a couple weeks, some not great price action. So we back off, period. Thomas Lee, this is bullish, okay? This is saying, listen, regardless of what you think, the majority of the people missed out on this huge rally off the bottom, okay? 5 trillion in money markets, 2 trillion in private equity cash, 1 trillion net cash raised by corporates year to date, basically 8 trillion or 40% of the US GDP and 35% of the S&P 500. He believes that that is very bullish. And so I actually agree with that in saying, I think downside will likely happen. That's normal price action, but you're on the other end, seeing the other end, and what that feels like for the person that was like, man, I got too much into my own head. I sold when I told myself I would never sell, and they sold, haven't got back in. There's a lot of money on the sidelines waiting on a dip. So don't be surprised if we don't see any major dips. You might see a 10 to 12% dip. I've talked about that. But don't be surprised if this surprises you mid and long term, okay? And one more chart that is actually bullish as well is, you're like, how is this bullish? To see this many people bearish is actually bullish. Usually good things happen when the majority are one-way sided. Meaning if too many people were bullish, it usually goes the opposite way. The market usually goes the opposite direction. If more people are bearish, the market usually goes the other direction. Perfect example. Where we were in March, the market was down significantly. The bearish number was huge. People were in cash. What happened? We had a 44% rally. So it's a contrarian perspective, but that is usually what happens. There's no one as bearish as a sold out bull. In short, saying is a lot of people missed out on the rally. Okay. So don't be surprised if we see some downside movement, but don't get overly bearish. In short, the economists in this environment you're not going to be a good investor. You rarely are economists good investors because they can't get out of their head that the market is not the economy. The market is pricing in 6 to 8 months ahead. And we were priced for almost perfection, in my opinion, here. Which is why I sold to say, listen, if we get anything in the news at these levels that is even debatable, not even negative, which the Fed basically said, hey, we're going to support this economy, okay? And the fact that they said they were going to do this till 2022 actually concerned people to say maybe it's worse than we thought. Market plunged 5 to 7% the next day, and here we are. Now we had a nice rally. We had a nice rally last week, 2 weeks ago, Friday and Monday. Then Tuesday, Wednesday, Thursday, Friday of this week, we're basically range bound. And don't be surprised if we are range bound, okay? So let's go to the next chart. Short term, again, the levels we're watching, take a look here. This was the gap that I'm saying this is going to be tough to get through based on the elevated levels that I'm seeing. That happened. Now, it'll be interesting to see what happens Monday. It's all going to probably be case count driven. I'll be honest with you. So you got to pay attention to that stuff. But price action has not been bad at all. It's a positive week. Okay. So you don't just take the last day and forget about the rest. Okay. So put call ratio, we've talked about this. We got as low as 37. That was a sell for me. I'll be honest with you. That's where I was saying, I don't care if it goes 1 to 2% higher, which it did. It went 1 to 2% higher, and we plunged 5 to 7% in a day. Stupid stuff happens when you get to these levels, period. Not a lot of good. Doesn't mean there's not opportunity during those times, but I reduce exposure during those times. So the VIX as well, the fear index, I would like to see, and I've been harping on this on Facebook, I want to see this get out and below the 50-day moving average. Right now it is above the 50-day moving average. The blue line is at 35. The 50-day is 33. Intraday, Friday, yesterday, we were below that, but it just could not hold. So there's still this fear that is out there, and rightfully so, in my opinion, that case count could cause a second wave. I hope it does not. Again, I am an optimist, but I have to be a realist in the market when things get extended. So I want to be real about that we have no problem, and clients know this, we have no problem in selling if we see elevated levels. And we, on a lot of metrics, we're seeing that, and we adjust accordingly. On a 5 to 7% dip, we bought that day. We bought Thursday at the close, added about 20%, did very, very well. I'm debating whether I need to take more gains at this point. But right now, I feel comfortable with the amount we have invested, with 75% in cash ready to enter. Do I wish I had a little more? Maybe, but there's still some negative sentiment out there that I think might bring us down a little bit. What I would like to see, ideally, again, what I want to see and what will happen are going to be two different things. But here is the peak, here's the trough, 50% of that would be 2,800. If that happens, this will be bought hard unless New York case count continues to increase. That would not be a good thing for the market. Okay. So I would like to see that retracement. I don't know if we'll actually see it though. I will be adding on the way down in case it does go that low. If it goes that low, you're going to see likely buyers come in at this point. Okay. So mid and long term, bullish. Short term, there are concerns to minimize risk. In short, is where we stand. So if you have questions, please reach out to us. That is what we are here for. Okay. These are frustrating times because Tuesday, Wednesday, Thursday, Friday was in a tight range. You get emotional. Oh, great. Finally, we're going up again. And then the intraday goes down 1%. These are frustrating times. They're not fun. But I'm telling you, these frustrating times lead to good things. We've been in this range for 2 years. When you get sideways consolidation, eventually, especially with the amount of cash that are on the sidelines, it leads to good things. So do not get too bearish. Do not lose your mind when things go down. They will go down. it's a buying opportunity. In short, what I'm saying. The market goes up 85% of the time. It doesn't really matter what the fundamentals are at the time. There are concerns. The Fed is pumping money into the system. That is not a bad environment for equities. You're going to stick your money in a checking account that earns 0 right now? Good luck with that. In short, there are opportunities ahead. Now, short term, I think we'll see a dip. Mid and long term, that will be a buyable dip, in my opinion. So hope that helps. I want to be candid with you again. There are many advisors, and this is not a diss. There's nothing wrong with it. Long term, you'll be fine if you just buy and hold. But when we see elevated levels and see concerning environments, like we saw here, we were seeing technicals where like, this is a little elevated, take some off. That we believe is the difference between us and many other investment advisors, is we are willing to take money off the table, and because we're a little more active than most advisors. So hope that helps. Let us know if you have questions. Have a great weekend. Again, if you have questions, bring them to us, because nobody else is managing your account. You have to understand our mindset. Hopefully these videos are helpful. Thanks again. Enjoy the sun. We have it in Ohio right now. I'm not sure it's everywhere, but we're not complaining in Ohio. Thanks again. Bye.